Okay, so in the next of our series of videos focusing on those key diagrams, so important for analysis marks at A-level and IB, we're going to take a look at producer subsidies, this time just using supply and demand analysis to help us along the way. Let's take a market, wherever it is, it could be a market for a commodity or a market for a service, where there's a supply curve pre-subsidy showing the marginal cost of the producer, and the demand curve, the willingness and ability of consumers to buy the good or service. Now there's the original equilibrium quantity of Q1 and the market price of P1. If the government offers a subsidy to producers, of course that is a financial payment which effectively reduces their costs, and other things being the same, a subsidy causes an outward shift in the supply curve. The supply curve is shifted down by the amount of the subsidy. So the subsidy per unit is the vertical distance between the two supply curves shown in my diagram. Other things being the same, ceteris paribus, this will lead to a fall in the market equilibrium price and an expansion of the market equilibrium quantity consumed. So Q2 will be the new market equilibrium, sold at a unit price of P2. And this is intuitive that subsidies to producers lead to lower prices for consumers and a higher output in the market. Of course, the effects of these things depend on the size of the subsidy, the scale of that shift in the curve, and also things like the coefficient of price elasticity of demand. There's the subsidy per unit, it's that vertical distance. So in fact, although consumers are paying price P2, the producer will get P2 plus the subsidy, that financial payment, which is there. So you have to add on the subsidy from price P2, draw it across to find P3, which is the price that the producer gets, whereas P2 is the price that the consumer pays. So subsidies help to lower prices and expand output, but there is a cost. There's a cost in particular to the government. You see that the subsidy per unit is there, the quantity is Q2, so in fact Q2 times by the subsidy per unit will equal the total government spending on the subsidy. And that's your basic subsidy diagram. Now be prepared to analyse the effect of a subsidy on things like consumer welfare. So you might bring into the diagram, you might label the areas of consumer surplus both before and after the subsidy. Clearly producers are better off because they're selling more. If we think about the diagram beforehand, they're now selling more at Q2 than they were before, and they're getting a better price. They're getting P3 instead of P1. So subsidies are common, and they invite exam questions where you are asked to evaluate some of the benefits and the costs of subsidies for both advanced and emerging developing countries. Okay, hopefully that was useful. In the next video, we're going to look again at subsidies, but this time use your year 13 second year economics using cost and revenue curve analysis. Thank you.